Meet Joe. Joe will help me to explain you what is price to earning ratio, or in a short term PE. Joe has an excellent coffee shop. The coffee shop does so well that it's fully packed from opening until closure. Joe wants to sell his coffee shop and I want to buy. But should I buy Joe's coffee shop? How can I decide? Well, I will try to use price to earning ratio to help me evaluate Joe's coffee shop. Let's see how to do it. Well, Joe wants for his coffee shop a price of $3,000. That would be the price. Joe's coffee shop makes $1,000 per year. That will be the earnings or net earnings. If we divide the price by the earnings, we'll get the price to earning ratio, or in a short term PE. So 3,000 divided by 1,000 give us 3. The dollars cancel each other and we're left with the years. The PE is 3 years. Wait a minute, 3 years? What does it mean? It means that for every dollar we invested in buying Joe's coffee shop, we'll start seeing a return only after 3 years. Let's see how it works. Well, we said that after 3 years of making $1,000 per year, we're gonna get $3,000. This compares to the initial price we paid. So only after 3 years we're gonna return our initial investment and start making money out of this coffee shop. What is the return we expected to see from this coffee shop? Well, $1,000 per year divided by initial investment of $3,000 will give us a 33.3 yearly return. That sounds excellent. I want to buy Joe's coffee shop. But wait a second. There is another coffee shop in the neighborhood. Dan's also selling his coffee shop. Let's check Dan's numbers. Well, Dan's coffee shop makes $5,000 per year and Dan wants $50,000 for his coffee shop. If we divide $50,000, which is the price, by $5,000, which is the earning, we get a PE of 10. The yearly return will be after 10 years, $5,000 divided by $50,000, that would be 10%. I'm not sure which one is better, so let's try two investment scenarios. In the first scenario, I'm going to invest my money for 10 years. So in Joe's case, after 10 years of $1,000 per year, I'm going to have $10,000. Minus the $3,000 of initial investment, I'm going to come up with a profit of $7,000. In case of Dan's coffee shop, after 10 years, I'm going to have 10 years doubled $5,000 per year, which will be $50,000. Minus the initial investment of $50,000 will give me $0 as profit. Well, that makes sense because we said PE is the number of years it's going to take for us to make profits from the initial investment, and in case of Dan's coffee shop, as we said, it's 10 years, so after 10 years I'm not going to see any money, only from the 11th year. So for surely after 10 years the best investment will be Joe's coffee shop, and I'm gonna choose this one. But what happens if I invest my money for 20 years? Well, in case of Joe's coffee shop, making $1,000 per year will give me $20,000 minus the initial investment of $3,000. I come up with $17,000. Not bad. Let's check Dan's coffee shop. After 20 years of $5,000 per year, I'm gonna get $100,000. Minus the initial investment of $50,000, my profit is going to be $50,000. Well, in that case, it looks like Dan's coffee shop is better. How else can I use the price to earning ratio to make a decision when I'm evaluating an investment? Well, let's check some real life examples. I love Apple stocks. I guess most of you also love Apple stocks. You also love this channel, so please consider giving the video a thumbs up and subscribing. Thank you. Well, Apple stock price to earning ratio is 29, almost 30. That means, as we said before, that it will take almost 30 years for us to see return on our initial investment in the form of company earnings. Well, as for itself, it doesn't say much. Let's compare Apple to another big company, which is Intel. Intel price to earning ratio is 12.9. It looks like Intel is a better investment, but is it? Well, their business is not exactly the same. Maybe we'll try to compare Apple price to earning ratio to the S&P 500 average price to earning ratio. Well, when recording this video, the average S&P 500 price to earning ratio is 44.13. And as you can see, comparing it to historical data, this is one of the most higher values ever. Well, maybe we'll try to compare Intel and Apple price to earning ratio to their historical data. Let's start with Intel. We can see that Intel price to earning ratio is 12.93. Comparing it to the historical data, the median is 14 and the average is 13.7. This might suggest that actually in this point of time, Intel might be a good investment. Let's check Apple. Apple current price to earning ratio is 29.41 compared to the median or the average. While you can see the values there are 14.6 and 19. Does it suggest that Apple is overvalued? I'm not so sure. So let's try another method. Let's try a price to earning valuation model. But before this, disclaimer, this is not a financial advice. I'm not a financial advisor and you should not listen to YouTubers when making financial decisions. Well, let's imply price to earning growth model to evaluate Apple's stock. So as we said, this is the current PE 29.41. The median is 14.6, the average is 19. Put it aside for a second and create our model. Our model works like this. We enter the earning per share based on analyst estimation for the upcoming 2 years. This is done over here. Also based on analyst estimation, we have the growth of the earning per share for the upcoming years. That will be 15% for the next 3 years, then 10% and then 5% because no company can keep such a high rate forever. As we can see in 2030, earning per share is going to be 10.72. Now how can we use this data? If we assume that Apple's price to earning at that time will be 17, which is between the median and the average in this case, we double the earning per share in the price to earning and we get a value for 2030 of $182. This is not today's value because our money could have worked for us in other ways in the meantime. I usually want a rate of return of 7.5% on my investment, so I should start discounting back this value until today by 7.5% a year all the way until today, and I'm getting a value of $95. Current price for Apple is around $130. This suggests that Apple is highly overvalued, but is price to earnings still a relevant measurement tool, and does the historical data relevant? Or are we heading for a new economy and new levels of price to earning ratio? Well, let's try and use the current price to earning ratio. Instead of 17, let's switch it to 29. Whoops, abracadabra. Now if we use 29, we come up with the current value of $162. This is $30 above the current market price. Should we run and buy Apple stock? Well, you should have to make your own decision regarding that. Well, let's summarize everything that we learned so far. We saw that price to earning ratio gives us the number of years to return our investment. This is correct for a coffee shop, for a stock, or for a real estate. We saw that price to earning ratio is a comparison tool. We can compare companies to each other, we can compare companies to the index, or we can compare the company's data to the historical data. And we have seen we can use price to earning ratio to create a growth model valuation based on earning per share and price to earning. And regarding Apple stock, drop a comment below. Which price to earning value do you think we should use in our growth model? That's it for today, guys. Please consider subscribing to the channel, invest wisely, and see you in the next videos. Bye!